If you're a property developer, investor, or business owner thinking about your next property development, this video can save you hundreds of thousands of dollars and possibly your life. Every year, people step into property development only to find themselves blindsided by income tax, GST, land tax, stamp duty, and other government fees. Sometimes they even end up donating half of their profit to the government, just because no one ever explained how the rules really work. I'm Davie and I'm a chartered accountant, and I've worked with hundreds of business owners and developers through this process. And in this deep dive, I'm going to show you exactly how to protect your profits and avoid the most expensive mistakes that even seasoned developers make. By the end of this video, you'll know how the ATO decides whether your profits are taxed as income tax or capital gains tax, why even one project can trigger GST, the real impact of stamp duty, land tax, and structures on your bottom line, and how to set up your development so you don't get caught out. Let's get into it. When it comes to property development, you need to understand the intention of what you're doing. People don't understand that when they buy a property, there's a difference between investment versus development. So development is when you're a developer and you're building something, you're knocking it down, you bought this piece of land, or you bought a piece of land with property on it, and your goal is to knock it down and rebuild and build a new property. So that there, the ATO classes that as development. There's a difference between a property developer versus an investor. A lot of investors get it wrong. And then they end up getting classed as a property developer by the ATO, and it creates a serious issue with taxes. It creates an issue with you thinking that you were eligible for concessions, but you weren't. So it results to you could be paying like 20-30% in taxes and not claiming the right amount of taxes back as well from the ATO. So as a result, you get double tax. Yeah. So a lot of developers, first time developers get into a lot of problems, and they end up going bankrupt as a result of a deal with doing development. And you will start noticing as a developer that the government charges a lot of different types of taxes, and they get away with different taxes on the developer. And hence why you start understanding that in Australia, it's getting harder and harder to become a developer. And a lot of people are complaining, and as a result, maybe taking too much shortcuts, and there's just too much red tape. So I'll go into more detail on the tax side and the structuring, and I'll also go through the numbers a bit. That's my job. The main goal for me is to talk about the taxes when it comes to development and investment. And we're talking about more you buying a property, knocking it down, rebuilding, or your plan is to knock down, rebuild. Not just buying a property and holding it for and then just renting it out. When you're buying a property just to rent out, it's an investment. It's on capital gains tax. If you hold it for more than 12 months, you get a 50% discount. If you decide to move in it, it's exempt from taxes because it's your home. Yeah, so that's how investment properties are, and that's how it has always been. I think I've done a deep dive on that before, but this one here, as I share my screen, it's all about, are you a property developer or are you classed as an investor? So the ATO has created a difference. So a lot of people see this as the same, but actually there's a difference between the two. So investor, usually people want to be an investor because when you're an investor, you get the 50% discount. So if you make a profit on the sale of the property, you get a 50% discount. So your tax rate, if it's at the highest tax bracket, goes from 47% to 23.5%. And that's the tax you pay on the profit. You get to claim all the expenses, the holding costs, the cost of the land, the cost of the purchase, legal fees, all that stuff gets added up. And then it gets taken out off the sale price to work out what the capital gains is. Then you get a 50% discount, and then you apply the 23.5% tax. That's how that normally works when it's on the capital account and when you're an investor. However, the ATO then classes property developers differently. And they don't care if you haven't been in the business of property development for quite some time. Sometimes they do take it in consideration, but they look at mainly, are you running a business? And if you're running a business, they see you as a property developer, and they see you as you're running the stock, or the cost of the land and the construction costs. They see it as trading stock. So very similar to me buying this calculator. So if I'm in the business of buying calculators and selling them. So I buy them for $10 and I sell them for $50. Let's just say that there's a massive markup. All right. So I sell them for $50, but I get them from $10 from, say, China. All right. This here, if I do that, that's on the revenue account, and that's me running a business. I'm not technically a property developer, but I'm like running a business and selling calculators. I might touch it up. I might put packaging on it, might put a brand on it, and then I sell it for $50. That there, the ATO says that if that's not capital, you're not an investor. You're not holding you don't hold the asset for a very long time. Your intention is you don't get any returns from it. The only return you really get is from you like building the product and then selling the product. And that there is a business. And so therefore the ATO sees that you're running a business, so therefore you don't get the 50% discount, and you don't run it like you're an investor. So they apply that knowledge and that understanding to property developers as well. The ATO sees property developers very differently. They see the property purchase as stock on hand or trading stock. And the way it works is that you can't actually claim it as a tax deduction or put it as losses. They just keep it as trading stock until you sell the property. And then what you do is, what the ATO does, or advises you to do, is you take up the sale price minus the trading stock, minus all the improvements or construction costs, minus any other expenses you've paid, and then they work out the profit, and then you pay the tax on it. But the worst part about it is there's different taxes that apply. It's not just capital gains tax or income tax, which is as an investor, it's 23.5% because you get a 50% discount. In this case here, it's based on the tax rate for the business or the individual if it's owned under Ali's name. So for example, Ali, your situation, say you don't move into it, say you do sell it off the next day once it's built, and you get the OC, you got all the subdivision or whatever it is that you're building, and then as a result, you put it on the market and you sell it. And then what happens there is that because it's in your personal name and it's in your the ATO classes you as a business, they'll see that your tax rate is 47% because you made a bucket load of profit on it, and they'll tax you 47%. So that's if you sold it and your intention was to knock it down, rebuild, and not live in it. Okay, that's the example that we're providing. The ATO doesn't just do that, though. They take 47% tax on the sale, on the net profit, but they also take 10% profit on the product. So on product sale. So now because the property is a new residential property, and remember the example of the calculator, this calculator here I sold for $50, but I bought it for $10. So I get to claim 10% GST on the $10, but I also have to pay GST on the $50. So therefore the ATO slugs you for that as well. And that's where a lot of first-time property developers don't realize that, and they get slugged for GST 10% on the profit, and then on top of that, a income tax of 47% because they bought it in their personal name. And the worst part about it is when it comes to property development, when you do a good job and you make money on it, what happens next? You're like, wow, this is working. I'm going to be a full-time property developer. So you take the profit that you made and you invest it in another investment. So you do another property development while that's happening. So you do side by side maybe, or the next 3 months, once you sold a property, you want to use that money, buy another property and redo the same thing. The worst part about it is that when it comes to taxes, there's a timing difference. And when it comes to property, there's also a timing difference of purchasing as well. So you may have spent all the money already and not paid the taxes on it. And then next year later, the ATO hits you up with the taxes bill, but all your money is tied up in this second property development that you're doing, or the third or fourth. So that's where businesses go under. That's why people go bankrupt. because they don't account for the taxes that need to pay. And there's not just GST and income tax. There's stamp duty, because you have to pay stamp duty to take over to change over to buy the property. Then you also got land tax, and land tax is like a state tax that gets taxed on the property holder if at 31st of December. Then you also got council rates. You've got development costs, and then a whole bunch of other probably like red tape that you have to pay for that to work. So you've noticed that the government, when you do property development, you get slugged for income tax, you get slugged for GST, you get slugged for stamp duty, you get slugged for land tax, council rates, and I'm running out of breath, development costs as well. Like, it's just so much different government tax that they take a piece of it. And as a result, that's why a lot of developers, if they're first-time developers, they don't realize how much the government takes as well. So just want to point out that when it comes to, and I'm scaring a lot of people, but when it comes to property development and first-time property developers, the best thing you should do for yourself is to get the right advisors to help you and guide you throughout the process, and do they call it a feasibility analysis to see what the taxes you're going to pay, what things are going to go out. And luckily for you, I've drafted an example for you guys that go about on what actual extra costs that you might have to pay and things that you have to look out for. So there's like stamp duty, there's land tax that you need to pay, there's GST, there's what is called interest as well. That's obviously not a government cost, but it's a big, heavy cost that you need to pay. And then there's also income tax at the bottom. Yep. Cool. All right. So that's why you need to be sure the difference between revenue and capital. So capital is when you buy a property and for investment, and you hold it for more than 12 months, most likely usually 5 years, and your plan is not to sell, your plan is not to develop it, knock it down and rebuild. Your plan is just to hold it and rent it out. And that there, the ATO sees it as your investor. They tax it as a investment, so therefore you get a 50% discount if you ever sell it. Revenue is you buy it with the intention to knock it down and rebuild a new set of apartments or new set of duplex or a new house. But there is an exemption. If you decide to move into it and you're buying a property for your home, the ATO cannot say that you're running a business. Very similar to this calculator. If I bought this calculator for $10 and I do it up, make it look nice, and now it's worth $50, and I use it. I use it for as my for the next 2 to 3 years, 5 years as an accountant. Technically, I'm not running a business. They can't argue that I'm selling calculators for a living. So therefore, because I've actually used it for personal use, 100% of it was used for personal use. I just made it look nice and lavish because I just like my calculators, which is very similar to homes. So if you do up your home, you knock it down and rebuild, and then you build a very nice house for yourself that's suited for you, and you live in it for 3 months, 6 months, or 12 months, or forever, and then you decide to sell it, the ATO can't really say that you're a developer as well. So therefore, a lot of these taxes don't apply to your situation as well. But you got to prove it. And how do you prove that it's your main residence? You got to live in it. You got to change your address. You got to have water rate, internet rate, or internet fees or subscription going through it to prove that you've actually lived in it. So you got to be very careful though, because some people try to pretend to live in it, and that's where there's a bit of an issue, because the ATO is getting smarter and smarter. So I don't recommend making that trying to do something like that. Go in, live in it, and if you decide that after 6 months that this is not the right thing for you, then you can sell it, and then the ATO may treat it as capital gains, and most likely will. Okay, but if you keep doing this and you keep building property and then you move into it and then you sell it off, over time, repetition makes it seem like you're a property developer as well. So you just got to be careful. There is like a timing and also consistency of your work. Like if you keep knocking down rebuilding, it does make it a bit suspicious for the ATO. So I just there are some people that they think that they can just keep knocking down rebuilding, moving into it, and then selling it. But it's not easy to also knock down, rebuild, move in, and sell every time, because that disrupts your life a lot as well. Yeah, cool. Does anyone have any questions? Is it correct that you can only claim holding interest on unimproved land when it's in the company? No, I think you can claim it wherever it's in your personal name or in your company. It's just that in your personal name there are like, it just depends if you're renting it or not. So rental income. So you got to work out. Remember, when you're an investor or a property developer, there are two types of transactions. There is the transaction of renting the property out, or there's the transaction of selling the property. They're the two main transactions you have as a business, as a property owner. And as a property owner, you got to determine the interest that you're claiming. Is it going to be on the rental income? Like, do you claim it against the rental income, or do you claim it against the sale of the property? And if you haven't been renting it out at all, then technically that interest that you're incurring, they call it holding costs, and you put it against the cost base of the sale. So when you sell it, you do sale price minus cost base, which also means holding costs, and you work out the profit from there. But if, for example, you rented it out during the year and you're an investor and you've rented it out for 5 years, then you get to claim the interest against the rental income. Yeah. So you're saying that if the land, there is no land on it. David, my question is, on land which is not rented, just land with no building, but something you might build on it. Yeah, that's a special case. I think unearned, like if you've got I can't remember specifically on this one because it's a specific example, but a quick Google search, you'll find it. But basically, yeah, I believe that you just hold, it just becomes holding costs and it gets added to the cost base. Yeah, if you ever sell it one day. Yeah, because technically it's still cost, like to you. It's just that you don't ever seem to be able to claim it. Because there's no income to claim it against. Yeah, so that's why people say, people try to claim it against their wages, because technically you bought this land, you're paying all these holding costs, but you can't claim it. So they feel like it's not tax deductible. It is tax deductible. You just need the income to be able to claim it against. And the ATO just says that, well, it's not. There are two types of income transactions: rental income and sale of the property or the land. You aren't renting it, so we can't let you claim it against rental income because you have no income. And then the second one is you haven't sold it yet, so therefore you can't claim it. Yeah. So I think it's a myth. Like, yeah, you can claim it, you just can't claim it on any income because you haven't made any income on it. Cool. All right, Ali, what if I'm renting a room too in the new place? How does that work? Oh, okay. So I think what you guys are now asking is more just more related to the investor side. But if you do rent a room or two in the new property that you live in, so Ali's situation is basically, I built a property. I bought a piece of land, I knocked down and rebuilt it, and then moved into it, and then decided after a few months I rent out part of that property. If you rented part of that property out, that means that you have started making income on your property. Because initially it was completely exempt because 100% of it is used primarily for your place of residence. And now you have to take in consideration 80% is primary place of residence, and the other 20% equating for the rooms is actually for income producing means. That means that now when you sell the property, there could be tax on it for that portion. So Ali, just be careful of that when you rent out a room or two. And the weirdest thing about this rule is that if you decided to move out of it and rented the whole thing out, 100% of it out, it could be exempt from taxes due to the main residence exemption. So there's this concession that's called the 6-year rule that allows you to claim the whole property as your main residence, even though you've rented it out after you've moved out for the next 6 years, if you have no other main residence. Like if you've moved to another city and you're renting on the other city, or you move back home to mum and dad's place, you can still argue that the home that you initially lived in is your main residence, even though you've rented it out for the next 6 years. However, if you're living in it and you rent part of it out, you can't use the 6 year rule. So the 6 year rule is designed for people that, travel for work or move out for a little bit and come back to that home. But yeah, if you decide to use a part of the house for rent, then you actually lose the main residence exemption for 100% of the property. Cool. All right, I'm gonna move to the next thing, or I'm gonna miss everything. But that's very important. I want to kind of just establish that there is a difference, and you need to be aware of the difference between capital and revenue. And you can see that sometimes it's not great to be in a property developer because of all these extra taxes that you need to pay. And sometimes it's better just to be an investor. So as you can see, like the questions that are getting asked right now are just going, oh, well, how do I become an investor? So the goal here is actually that for most people that are buying one or two properties in the next 5 to 10 years and developing it, knocking down or rebuilding, most of them are investors because the plan is to keep the property for a very long time. They're not planning to sell it. But if you do decide to sell it straight away, that automatically is very close to the ATO arguing that you're a property developer instead. So I just want to be clear. There are some things that you need to be careful on, is that the ATO does look at it as a profit-making intention. They look at your intention. They want to know that if your intention was to sell, to knock it down, rebuild, or make profit on the sale of properties or sale of units, duplexes, they would want to see it as a revenue account, and they will also want to see you pay taxes on your business tax rate, GST, and pay all the extra costs. Okay, so I just want to point out, you also still have to pay this as an investor as well. It's not like you don't pay this as an investor. I just want to point that out. I was just saying that the government taxes you a lot. they charge you for everything. As an investor though, your intention is to actually hold it for long term and receive rental income. Okay, the difference between a investor versus a property developer is they're not trying to sell the property for profit. What they're trying to do is hold it for long term, and then what they're trying to do is receive rental income, and then they sell it for quite some time. However, there is a rule that the ATO has put down, and this rule you got to be very careful of. They can say that if you initially saw it as that you want to hold it and you want to rent it out and you want to but you never lived in it, for example, but you just rented it out for the next 2 to 3 years, the ATO says that they put out a rule that if you hold it for less than 5 years and you sell it, they still class the property as new residential property, and they may tax GST on it, and they may tax it on the business tax rate. So they put out a rule. So there's a rule that they put out here that says that even though you may have rented it out, a new residential property is a property where any of the following applies. It hasn't been sold as a residential property before. It's been created through substantial renovations. New buildings replace a demolished building on the same land. So any of the following, just so you know, one of these properties is listed that has been rented out for less than 5 years. Or more than 5 years, but has been actively marketed for sale while it was rented. So what I'm trying to point out is that the ATO may still class it as new residential property, even though you've been renting it out, if you don't hold it for more than 5 years. So the ATO's put out a blanket rule. They basically said that in order to be an investor, we want you to hold the asset for more than 5 years. Going back to the initial question was what happens if I live in it? I think when you live in it and you live in it for quite some time, this 5 year rule doesn't apply. Yeah, because it doesn't have any talk about you moving into it. So I don't think it applies to this situation. You're not renting it out. Yeah, just to point that out. So if you ever marketed a property for sale, it seems you want, yeah. So you got to be very careful about marketing it for sale during the first 5 years. What you should be doing is making sure that if you want to be an investor, then you should try to hold it for 5 years. Yeah. Okay, like I said, you shouldn't do things for tax purposes. I'm just telling you guys the rules on how it works, but the ATO is clear on this. Okay, so again, I think some new people have just joined, but I just want to say, repeat what I said. You need to be working out if you're an investor when it comes to buying property and selling it, or you are a property developer. And the benefits of being an investor is it's classed as capital gains. And so therefore you get a 50% discount. So your initial tax, if you purchase in your personal name, of 47% goes down to 23.5% because you get a 50% discount. And there's no GST on it. So it's a lot of people prefer to be an investor when it comes to buying a property and then selling it, a few years, 5 years later. However, a property developer is very different. You get taxed on your business tax rate. You're classed as a business, so you can be taxed at 47%. And because you're selling new property, new residential property, so remember, the definition of a new residential property isn't just a property that no one's lived in or it's not being rented out. It's like if you've rented it out even for the last 5 years and you sell within 5 years, they still class it as new residential property. So you got to pay GST on it, 10% on the profit. And then on top of that, all the other extra costs and the construction costs and all that gibberish. Sometimes you do all that and it ends up you not making any money whatsoever and you break even. And that has what's been happening in the last 2 to 5 years. And that's why a lot of business owners, property developers have gone bust or can't afford to pay for the construction costs. And that's why no one wants to be a property developer anymore, or less people are property developers, because it's just, you're taking on so much risk. And who benefits from it? Who gets paid no matter what? I can see some smiles, but we can tell who gets paid no matter what, right? When there's a transfer of property, land tax, council rates, GST on sales, and they don't do anything. All they do is the development application and just approve or not approve it. And they get to take so much of it, a piece of it. And that's why a lot of property developers that are clients of mine are just they're telling me, Davie, it's just too bloody hard to build property now. So don't blame the builders sometimes. I don't think it's the builder's fault. I think it's just the red tape that there's just too much taxes that you have to worry about. I now want to explain to you guys, if you were to do a property development, if you were classed as a property developer, what should you do? All right, actually, I'll go into structuring first. We should always start with structuring. All right, so if you buy a property and you decide that you want to buy it to live in, and even if you knock it down, rebuild, or you decide to just renovate it, then no matter what, most of the time, I'm saying 99% of the time, you're buying in your personal name or in your partner's name. Reason being is because you want to claim it as your main residence. If you buy it in a trust or a company, the ATO can argue that it can't be a home, because how could a company live in the property? How could a trust live in the property? So they will argue that you can't claim the main residence exemption when you come to sell. So that's why a lot of people, I don't know why they do this, but they watch a lot of stuff online. They watch some guy named Davie Mack and they say buy property in the trust, and they assume that they should buy things in the trust and buy their homes in the trust. Big no-no. If you're planning to live in it, if that's going to be your home, then you most likely want to buy it in a personal name to claim the main residence exemption. Okay, let's just ignore that you're trying to live in it. Let's just go straight to it's going to be for investment purposes. If you're buying to rent and you're buying to, hold it for quite some time, try to get equity on it when it goes up in value, and you're not knocking down and rebuilding, then you've got options. You've got a company, which like sometimes they call it a bucket company. You can buy in a trust, or you can get a very complex structure like something like this, option 4. Okay, we generally say it's either going to be in your personal name, company, or a trust. If you've watched my videos before, I don't really like trusts in New South Wales because of no land tax-free threshold. So you don't get a land tax-free threshold. So I'm not a big fan of trusts in New South Wales. And some states like Victoria, it's also very bad. You get taxed quite a fair bit. But when it comes to investment companies and buying in a company, I generally sometimes like it because of the fact that you can get taxed at 25 to 30% rather than in your personal name at 47%. Because if you're a high income earner, you got to look at the details. If you're a high income earner and you're trying to receive rental income on this investment property that you're buying, and you're not like knocking it down or rebuilding, and you're not doing a development, as an investor, you want to try to keep your tax as low as possible. So you may consider the investment company. And I know some people are going to say, "Oh, you don't get the 50% discount." I get it. Like you're going to pay a bit higher in taxes instead of it being 23.5% because you get a 50% discount. It ends up being 30%. It's not that much more different, guys. Like it's 5 to 6%. But the great thing about it is this 23.5% on the 50% discount is based on the sale. But this 30% is sale of property plus rental income. So if you receive rental profit for the next 10 to 15 years, then it's actually better, personally, in my point of view, to get a 30% tax rate than 47% for the next 10 to 15 years. And if I don't ever sell, if I don't plan to sell, then why I won't ever really get that 23.5 or 6.5% deduction in my tax. Like I'm just keeping all the profits in the company, reinvesting it, buying more property, and then eventually taking money out. But when I do take money out, I'm taking it out as a dividend, and I get a fully franked dividend, and I get 30% credit for that. And when I retire, my income I don't have any more income. I can take that 30% as a credit and then apply it against my personal taxes. And so maybe I might not pay extra taxes as a result of that. That's why I love this. That's why I like a company to buy property if I'm doing it for long-term gain, right? If it's now leaning towards a revenue account, which is I'm a property developer, then I'm stuck with GST and I'm stuck with the business tax rate. So this is where I'm going to restructure and not buy in my personal name. So and there was an example that some of you guys missed, but one of the guys on here just asked, like, what happens if I'm buying my personal name and I knock it down and rebuild? I don't like that because you're going to be taxed at 47% if you decide to sell it straight away. So I actually just prefer to buy the property in a company, and because the ATO is going to treat me as a business, right? And so if I'm treated as a business, what's the company tax rate on a business? It's 25%. So it's actually funny. You can actually keep your taxes quite low. You can get as close as the normal tax rate on capital gains, when you get a 50% discount, by just putting it in a company rather than your personal name. So when it comes to property development, when you're buying a piece of land or you're buying a property that you're knocking down, rebuilding, and then you're going to sell it off straight away, your goal is most likely to structure in a way where you get the lowest tax rate. The lowest tax rate is usually a company in this case. Some people might ask, SMSFs, can you do it in SMSF? Apparently there's some tax practitioners out there that say that it's possible. I think it's too hard. I don't think it's possible. It's just too complicated to do a development in your SMSF. So you can't really get the 50% tax rate. I think the lowest tax rate you can get is 25% on the development of a property. So it's best to buy in a company, right? You can either buy it like in this company, option 2 or option 4. The reason why we like option 4 is if you've done some other videos, the goal of your when you do developments or making money, and when you invest and when you run a business, your goal is to separate your risk. And so therefore, if one of your risks does happen, worst case scenario, it takes down only a portion of your assets, not everything. So if you leave all your investments, all your properties, all your money in this company, and you do a development in this company, what do you think your creditor is going to do? So say that the bank, or say that the builder, or one of the workers, or someone sues you and goes after your assets, or goes after the property. You've got everything else tied into this entity, so therefore they'll go after everything. So that's why it's actually better to have a development company that owns the property. And then if you want to engage a builder, you get this, you pay this, you set up another company that might engage a builder. So therefore if the builder sues you, they'll sue the building company rather than the property owner. You can call this the property owner, for example. Yeah, and then you've got the building/development business. And this is what you see often. You see like businesses that go under, and then they get you think they're getting rebirth. They're not going. Not all businesses are going under. It's only one arm, and it's usually this arm, which is the building development company that has all the contracts. Whereas the owner of the land is in a separate entity. So therefore, even though this entity goes under, you don't lose the land. Yeah. So that's why there's a more complicated structure for like big and large investments. How does the ATO decide the tax rate of 25 to 30% if you're owning a bucket company? Okay, yeah, this is a very good one. So, Chris, I think you were late to this deep dive. Shame on you, by the way. Don't be late. I'm just joking. But basically, we talked about it, which was you need to work out if you're classed as an investor or a property developer. So if you are holding the asset for the intention of renting it, then technically your intention is you're doing it for investment purposes, not profit making. So if you're so your tax rate will be 30% because you're holding it as for investment. But if you just classed as a property developer, you're straight away running a business. That's how the ATO sees it, because your holding costs, your construction costs, and your cost of the land, they consider it as trading stock. And so you're like buying and selling properties for a living. That's how they see it. So therefore you're considered a business straight away, and your tax rate will be 25%. So that's why I say like that as a property developer, you should 99% of the time never buy the property in your personal name. If you're a property developer and you're classed as a property developer, like there's no way around it. You should always be buying it in a company. There's asset protection. It's 25% tax. If something were to happen to the property or the business, you can just knock it down. Like you can close down the company, liquidate it, and they can't go after your personal assets. But if you do everything in your personal name, you get taxed at 47%. They can go after your personal assets. It's just very risky. How do you borrow to purchase a property in a bucket company? How do the banks do this? Do you need to show your trading company value? Yeah, so best to speak to a broker, because I'm not a broker, not a mortgage broker. And I know people, I can probably introduce you. But the way it works is that they need to find where the income, they need to find the business or the individual that can guarantee the income for this bucket company. So if you own this bucket company, for example, and you make income in your personal name, like PAYG, then they can use your PAYG. But then you would sign probably a contract or agreement that personal guarantees the loan for this bucket company. Okay, so if you have a business, then it will be a very similar thing. That will just tie the business with the bucket company, and the business will probably have some sort of personal guarantee. Same with your personal name as well. So they just tie in like your business income and your salary income depending on where you get your income. Is there a way to borrow in your own name and hold the property in a unit trust so that you can claim interest at your higher personal tax rate, but still have the trust hold the property with a corporate trust? Reason could be co-developing, investing in another party, even with SMSF. Do any lenders offer a loan that supports something like this? Again, speak to a mortgage broker. And the one thing is that I guess this is the part where you're talking about negative gearing, Andrew. So like negative gearing is the part where you've got a high tax rate, or you're paying high taxes in your personal name or in whatever entity. Most of the time it's in your personal name, because taxes in your personal name is the highest, and you can't get that money out. And so as a result of that, you want to come up with tax deductions, which is rental losses most of the time. That's what most doctors do. Sorry, I'm not referring you as a doctor, but I'm just saying that most doctors are high income earners and they can't get the money out of their personal name into a company or something like that. So therefore, what they do is they come up with expenses to negative gear it. So when the expenses offset the income, they end up paying lower taxes or get a tax refund. So your question basically says that can we do that and then buy property in your trust? Yes, you can, but then the rental losses that you're making from the trust, if it's a loss-making property, gets trapped in a trust. That's why I'm again not sometimes depending on your investment, and that's why you need to speak to an accountant. If you're not doing property development and your intention is to be an investor, which is, let me just go back to here, which is your investor and your intention is just to rent it out and you're making losses, then sometimes it's actually better to buy in your personal name because your income's so high and you want to tax deduct the losses that you're making and negative gear it. So it really depends. Buying in a trust means that you lose those losses and you get stuck in the trust. So you got to then get some income in the trust to offset that. And you got to be careful with part 4A, which is anti-avoidance of taxes when you're creating a tax scheme. So Andrew, again, I think your questions are very detailed and apply to your situation. So guess if you have, when it comes to that situation or that time when you're planning to do it, you give me a call and we talk about it first. But remember, guys, like these structures that you're planning to set up, most of the time you're doing it because you're buying a property for your home, for you to live in first. If you're doing that, like I said, 99% of the time is that if it's your home, you buy in your personal name. And then when it comes to investment, like when you're buying your next one, you need to firstly class if it's property development or investor. If it's investor, then you've got 3 options: your personal name, company, or trust. If you're a property developer, most of the time, 99% of the time, is buy the property in your company because you want to get the lowest tax rate. You don't want to be paying 47% and you want to protect yourself. And then we talk about like if we need to set up different entities to protect the wealth you're creating. But it can be talked to. My recommendation is when you're going to do your next investment, you always need to speak to an accountant. I just want to give you guys like a broad understanding of what you should consider, the structures, the taxes that you need to be careful of. Can you buy a positively geared property in the trust then? Distribute all the profits in a bucket company? Yes. So you don't get the profit in your personal name and you get the CGT discount? Yes, you can. So there is something like this where people buy in this. So option 3, where they buy in buy here, and it's negative geared in the short term and then positively geared in the long term. Yeah, long term. It's positive. All right. So people do that. So people, what they do is they, in the short term, they know it's going to be negative geared. They buy, but they take the punt. They buy in an investment trust anyway because they know that it's going to be positive geared in say 3 to 5 years. And what happens is when it's 3 to 5 years and it's positive geared, they will set up a bucket company right here under it or next to it, side by side. And they will distribute the profits from the investment trust because the property is starting to be starting to be positive and getting a rental profit and then paying the profits over to here, and there will be a 30% tax rate on this bucket company. That way is a cheeky like structure. The only downfall about this is that you're just paying a lot more in accounting fees because you got to pay accounting fees for the bucket company and the investment trust. So you're doubling the amount of accounting fees by doing that. Sometimes like knowing that I don't even know when they're going to actually start being positive. Because a lot of the times these days, if you're buying in Australia, the properties are usually negative geared because interest rates are 6 to 7%, and rental yield on a residential property, on average, 2 to 3%. So you're making losses most of the time. So that's why buying in a trust is not generally the way to go. And also, the biggest factor is that land tax in certain states a lot higher in a trust as well. All right, one last thing I want to explain to you guys is if you're a property developer, so if your intention was to knock down, rebuild, and you weren't an investor, you weren't holding it for 5 years, your intention is not to hold the property at all. Your intention is to buy the property, knock it down, rebuild, and then you become a property developer. What is the, like, how do you calculate all the extra costs you have to pay? So this is just my way of doing it as an accountant, but there are a lot more detailed ways to do it. A lot of property developers will go more specific on this calculation. So my calculation here is actually quite basic. It's probably the most basic you can get, but this is kind of like a example of a feasibility analysis that you should do when you're buying property. And the reason why you do it is because of these reasons. These two, this and this, and where is it? Land tax. Here it is. These are the reasons why you got to be very careful, because see how big these numbers are. The GST payable, the land tax, and the income tax. If you don't calculate it or estimate it, you can see that it could take a lot of your profit. Yep. So let me give you guys an example. We've got this client who purchased the property or the piece of land, and it cost them 1.5 mil. And then before they purchased it, they wanted to, like, they brought a builder in, or that person was a builder. So they estimated the construction cost of being able to build, a duplex. They decided that if they were to build the duplex, it would probably cost them 1.6 mil. So they added the cost of land and the 1.6 mil, and they worked out that the total cost is going to be about 3.1 mil for land and for construction. However, and they thought, okay, because there's two of them, two duplexes that you're going to be building, well, a duplex, and then there's two houses that you can sell, that we're going to sell it for like 2.2 mil. So they added that up. It's like 4.5 mil in sale price that we're going to sell both of the properties. They weren't going to live in it or anything like that. They worked out that there's going to be a profit. And most people would just go, this is what most first-time investors would do. 1.4 mil, great, amazing, let's do the deal. All right, but really, from 1.4 mil, that's what they thought the net profit would be. Look how bad it dwindles down to. It dwindles down to 600K. And if they mess anything up with the taxes, it could be even more. So now, let me just quickly show you. 1.4 mil was the net profit with what we estimated most first-time property developers would think it is. Now, let's take in consideration all the other extra costs you need to pay. So when it comes to selling the property, you need to account for GST. So the way the GST works when you sell a property at the property development is they do something called a GST margin scheme. So what it is they take the sale price of the property minus the cost of land and divide it by 11. So I did that, and that works out to be 272,000. That is the tax you're going to pay on the sale of the property. That's the GST. And the reason why you get to claim the cost of land is very similar to the calculator concept. You buy the calculator for $10, you sell it for $50, you get to claim $1 in GST, 10% of the $10, and then you pay $5, which is 10% of the $50. So you pay $4 net in GST. Same concept applies to this sale of the property. You get to claim the cost of land, the GST on that. And they do something called a GST margin scheme. So you don't pay total 10% of that 4.5 mil. It's just too much. You get to claim you're supposed to pay the GST on the net profit. So anyway, GST ends up being 272,000. And then you also get a credit. All right. So don't forget, you would have paid for costs. You would have paid for the construction costs. You would have paid for a builder, the materials. So you get 10% of the construction cost as well. So that is a credit. So the total tax bill that you're paying for GST purposes, and this is just the estimate, there's other GST, but most of it would be these two, so therefore the net GST bill will be 112K, right? So that's how you calculate the GST that you have to pay. And then after that, this is the gross profit after, so sale price minus cost of land, minus construction, minus GST. This is what you're paying, all right? This, again, is an estimate. It's a lot more detailed and a lot more harder and complicated than this. I just made it very simple for you guys to understand. And then on top of that, when you buy the property and when you invest, there's something that you're paying on the side, right? Interest, bank interest. So I've done this kind of calculation here on the side, which works out like how much you can borrow and what you can't. So obviously, when you go to the bank to borrow money for construction and to buy the cost of land, you need to put in down a deposit. The bank will never lend you 100% of the deal, because then they're taking on the risk if it goes under. So what they want to do is lend you anywhere between 60 to 80%. And in this case here, they're lending 80%. So the deal is the total cost that the builder needs or developer needs is the cost of land and construction costs and GST, right? Technically. So it's that plus that and possibly even other expenses as well. So the total capital required is 3.8 mil, and the amount of they allowed to borrow is 3 mil. So therefore they need to put a cash investment of 800K. This is a very high LVR, by the way. This is very, very high. Generally, people want to go lower than that because they don't want to, the banks won't lend 80%. They will lend less. But let's just assume they did, or they borrowed the money off somewhere else and the interest rate's about 8%. And remember, when you do borrow the money, you don't borrow all at once. You borrow as the construction gets built too. So you don't borrow the full 8%. And like I said, the calculation is based on the whole year, but when you actually apply it, it's based on when you actually borrow the money. So therefore, the calculation is a bit more complicated than that. I took a very simple approach. So what I did is I did 8% of the loan. So interest here is how I did it, 8%. And I'm just assuming it's a 1 year build, right? It takes only a full 1 year to build the whole duplex and sell it. Could take longer. So you could add, extra 1.5 just to be safe. But in this case here, I've taken it as if it's 1 year build. So the interest is this. Look how much the interest is, 360K, just based on 3 mil. Okay, what happens next is council rates, sundry costs, like, other expenses, land tax, agent fees, legal fees, stamp duty that you have to pay to transfer it over. That's just a random figure based on the cost of land. And then designs, architect fees, and DA government costs, right? When you add all of those up, the total cost is about extra on top of the construction is 600K. So your total cost that you're paying is this plus this plus this. And first-time property developers do not know that they're going to pay all these extra costs as well, because they think that they can pay the interest at the end of the job or whatever, but they have to pay during the year. And so as a result, your net profit is only 657,000 as opposed to 1.4 mil. Yeah. So it's gone down significantly. And so what generally happens is they do this build, they pay for these extra costs, they forget about GST, they forget about land tax, and they forget about income tax. That's 400K. So they do the build, they make $600 or $1 million, and like the money comes into the bank account after settlement. They sell everything. They don't pay the taxes, GST and income tax. So why don't I pay the taxes? Because remember, income tax returns and GST is self-assessed and you lodge them. So if you don't lodge them, the ATO doesn't collect the fees, but they eventually will one day. So after a year or 2 years of you not lodging it, they'll chase you up, you get audited, you now cough up a tax bill of 460 plus interest. What happens then is that 600K or that $1 million, 1.4 mil they thought they were making is already invested in a second property or second development. That's where it comes to bite them and they have cash flow issues. So it's very important that you retain these tax amounts and you pay it to the tax office, not as soon as possible, but when the time is due, and you hold that money and you don't reinvest it out elsewhere. I just want to point out as well, the net profit after paying taxes, after the GST, after the income tax, ends up only being 500K, which is still pretty good, but you have to make sure that you sell it for 4.5. So if this goes down and you end up selling for 2 million each, then it changes everything. Like your net profit's only 150K. And you're taking such a big leap that it might not even be worth your while. So this is really important to do. And we can do it for you guys if you need help on it. But yeah, that's the calculation on feasibility. What are the typical analyzed ROIs you are seeing? Or like as in the profit? Or usually people try to make 25% on the project. So they usually try to 25%, 1 mil, yeah. But as you can see, it doesn't normally happen anymore. It's very hard. Yeah, like that's why it's because of the two main reasons why, and I've done a video about this, why the construction boom, why construction's failing. It's because there's just too much red tape. There's just too much taxes. Like there's just too much that the builders are paying for, and the rise in construction costs. Like it back then, when you were to build a duplex, it can cost you like 800K to build a duplex for both sides. Now it's costing you double the amount. So if you ran the numbers now, at 800, like your profit is net like is 25%, which makes sense. Well, it's more than 25, but yeah, which makes sense. But now construction costs and materials is skyrocketed. Loads of reasons why, supply constraints, whatever it is. I don't know what happened during COVID, why it increased so much. I'm not an economics guy, but that's why a lot of people can't build. It's because of rising construction costs. Can't find labor. Labor's gone up too. Cost of living. Due to the cost of living, labor cost has gone up. And on top of that, the red tape that the government's put in. Like too many dodgy builders taking shortcuts, so therefore they put in more red tape and then put in more regulations, then tax more, pay for more admin costs, and it's just it's a pile of bullcrap right now. And that's why it's so hard for you to make money. Yeah. So then check this out. Like if you look at after tax, what are you making? That divided by, like, say that it's a full investment, and you're investing this much, you're making 12%. It's sometimes not worth doing that. Yeah. If you do, but a lot of property developers don't see it that way. They don't see the full capital 3.8. They look at just the cash investment. So if you do that 495 divided by the cash investment, because that's the total cash they need, it's actually a pretty big chunky profit. But you're taking on a lot of risk because you're not. I know you're putting like 900 or 850K in, but you're not putting 850K if you've got a loan of 3 mil. It's like you're taking on a risk of 3.8 mil, losing 3.8 mil, not 800. But yeah, developers see it as cash injection rather than money that they borrowed. Cool. All right, I think that's it. Love you guys. I'll see you guys next 2 weeks. See you later. Bye bye.